Hello everyone, I am Sunil from Vision Inc. Today I would like to explain the partial revision of our business strategy and the update to our future dividend policy. First, I would like to provide a review and highlights of our full year results for the fiscal year ended December 2025. We began by declaring that we would invest aggressively during 2025 and 2026. In 2025, we achieved record high profits while steadily continuing our investments. I believe this is the result of actively pursuing precise targeting, the utilization of AI, and the optimization of our product portfolio and internal profit structures. Regarding net sales, we finished approximately 1 billion yen short of our budget. On the other hand, we achieved 100% of our profit targets, further increasing our operating profit margin. However, as noted under delay in recovery of travel demand in the global Wi-Fi business, the environment remains very challenging, with outbound travelers remaining at only about 73% of 2019 levels, partly due to the ongoing depreciation of the yen. Nevertheless, we continue to break our own records for both sales and profits. While overall travel numbers are down, corporate business travel is increasing. By focusing on this area, we have been able to meet our profit targets despite the shortfall in sales. Assuming these conditions will persist, we have revised our business strategy. While the global Wi-Fi business on the right is as I just explained, we also intend to continue growing World eSIM while maintaining our investment in it. In the information and communications service business, while profit decreased slightly despite steady sales growth, we believe we can expect future earnings given that we are reinvesting heavily in this area. As for glamping and tourism business, we are seeing high occupancy rates and an increase in unit prices through various options tailored to needs, and inbound travel arrangements are also steadily increasing. Despite the tough environment, we aim to further strengthen our high profit structure and become a company that customers increasingly choose. With that in mind, I would like to convey the changes to the business strategy and our dividend policy. Next is the partial revision of target value. Our targets were originally designed on the assumption that overseas travel would return to normal. However, as the yen has depreciated even further since then, we have revised our sales figures to reflect a more realistic outlook. The targets for these 3 years have been revised to 42 billion yen, 45.5 billion yen, and 50 billion yen. Meanwhile, we have confirmed that our profit targets can be maintained, and we intend to achieve them: 7.5 billion yen, 8.7 billion yen, and 10 billion yen. Consequently, our operating profit margins will improve to 17.9%, 19.1%, and 20%, and we will work toward finally reaching the 20% range. There is no change to the projected net income for the period. As for ROE, we are maintaining a level of over 20% as stated here. Next is the dividend, which I know is of great interest to everyone. Previously, the policy for 2027 and 2028 was listed as under consideration, but we have now clearly defined it. We will aim for a dividend payout ratio of 50% for both 2027 and 2028. Furthermore, we have established a new dividend on equity (DOE) target. This accounts for major market shifts, pandemic risks being one example, or the possibility of a temporary decline in profits following a large M&A transaction. Therefore, we have introduced a new setting to return whichever is higher: the payout ratio-based dividend or the DOE-based dividend. We hope you understand that this new framework for returns was created to adapt to changing circumstances. Next, I will explain the reasons for the plan revision and its strategic significance. As I mentioned earlier, the recovery rate of overseas travel is very weak. Also, somewhat sadly, Japan currently has the lowest passport ownership rate among developed nations. It's a great shame, given that it is one of the most powerful passports in the world. The passport issuance rate has dropped from 23.7% to 17.5%. While I sincerely hope this increases, especially with government support arriving later this year, we have adopted a conservative plan based on the current reality of this environment. On the other hand, we will continue to focus on establishing a strong foundation by strengthening our corporate business and increasing unit prices. Thirdly, it is vital to expand recurring revenue with a focus on gross profit and to strengthen cross-selling. It is essential that we have appropriate prices that lead to long-term relationships, which in turn encourages customers to purchase our other products and services. By strengthening these areas, we are creating a system that steadily increases the profit generated per customer. Regarding the lowering of the break-even point shown on the right, we believe this point will continue to drop as we utilize our aggressive investments in AI. Furthermore, we intend to remain proactive and flexible in pursuing M&A by utilizing our cash. With the new DOE setting for cash efficiency and maximization, and a focus on the fundamental improvement of ROE, we are aiming for 23.9% by 2028. As noted at the bottom, we want to achieve a 20% profit margin by 2028. Next is our strategy regarding corporate foundation and M&A. First, we will continue to strengthen the accumulation of our unique stock revenue. For large and mid-sized companies, we already have many customers using global Wi-Fi, so we will grow this segment by further strengthening internal process costs, systems, and security. For newly established corporations, the focus is shifting from landline phones to smartphones. We will use these, along with electricity, which isn't listed here, as front-end products to secure a customer base, and then add on cloud and security services through cross-selling. By shifting the weight from one-time spot revenue to recurring stock revenue, we will strengthen the system that increases our mid to long-term profit margins. Additionally, in the accounting BPO area, we are creating deeper relationships with customers. We are currently working on this because we believe that once a system for new sales methods based on that data is fully established, sales itself will be revolutionized. We are currently taking on this challenge and are determined to carry it through successfully. We have conducted many M&As to date, and as our customer base grows, we feel there is an increasing need to add new offerings to our lineup. These ideas come from customer feedback. We intend to aggressively pursue M&A that allows us to become a major platform where customers can purchase what they need at fair prices without burden, thereby increasing our cross-selling rate. Next is cash allocation. This covers the cumulative outlook from 2026 to 2028. First, based on this plan, the net income generated will be 17.8 billion yen, and we will have 10 billion yen in cash on hand after taxes and dividends. This represents our current and future cash. How we intend to use this is described on the right. First is M&A. Since we are still in a growth phase, we want to actively pursue growth investments, allocating 8.9 billion yen. If we cannot conduct M&A or other investments and are left with excess cash, we have set aside a framework of up to 8.9 billion yen for the acquisition of treasury stock as a shareholder return. Of course, this is not an all-or-nothing situation. We will prioritize investing for growth, and any funds that cannot be invested will be used for share buybacks. Additionally, half of the 17.8 billion yen, that is 8.9 billion yen, is allocated for shareholder returns with a 50% payout ratio. We have formulated a very proactive plan. Regarding the 10 billion yen on hand, this represents 2 to 3 months of monthly sales. During the pandemic, we saw a loss of about 500 million yen in 2 months, though we still finished that period with a positive operating profit. We have the strength to shift our portfolio even if something of that scale occurs. That said, we must not cause trouble for our stakeholders due to unforeseen events, so we intend to maintain a solid 10 billion yen in cash on hand. Furthermore, while maintaining stable dividends at either a 50% payout ratio or 8% DOE, whichever is higher, we will allocate 8.9 billion yen for growth investment and flexibly implement the acquisition and cancellation of treasury stock depending on the status of our M&A. We ask for your understanding in this regard. Regarding ROE, as shown in the table, we aim for 23.9%, whether through a 50% payout ratio or by using DOE to supplement returns during periods of aggressive investment or major market changes. We want to achieve the twin pillars of high quality growth and proactive shareholder returns. Thank you all for watching today. While the sales figures have been adjusted to these current numbers, we will focus on ensuring solid profitability, and we will continue to focus our efforts on that area. We also want to create a better future by achieving growth so that we can provide steady returns to everyone. We hope our shareholders will continue to support us. Thank you very much for your time today.